Good morning and welcome to the
Not enough room in the
Meet
case
Board
where I
of
didn't wear a
Realtors.
dress.
We are so happy to have these wonderful lenders with us today to talk to us about some of the nuances in lending these days. So first, I'm going to allow them to introduce themselves, and then if any of you has a question to get us started, we will start with that. If not, I've got a cheat sheet up here. Okay, so Sally, you want to start?
Hey everyone, Sally Vance. I'm with Cross Country Mortgage. I've been doing mortgages now for about 20 years. I specialize in self-employed investor loans. At Cross Country, we have 140 in-house products, and then we have another 120 we could broker out there for those really unique scenarios.
Awesome.
I am Faith Adams. I'm with Annie Mac Home Mortgage. I have worked in and around the mortgage industry for over 30 years. Used to do a lot of foreclosure business. Was super depressed at doing the foreclosure business. Decided I'd rather put people in their homes than take them out of their homes. That pretty much happened during the crash. I love working with Annie Mac. I specialize in construction lending. Also have a niche in the condo market, in the condo industry, but I'm versatile, can do just about any mortgage that's out there.
And I'm Deborah Crane. I'm with Fairway Independent Mortgage, and I have been around, oh my gosh, 40 years, long time. And
You were 12 like me.
Yeah, yeah. No, actually, I was 10.
Yeah, okay.
But anyway, I actually have kind of turned my thoughts of what I'm doing. So I am dabbling in reverse mortgages as well as forward mortgages. I specialize in first-time home buyers. So basically, I go from first-time home buyers all the way up to 62 and older for reverse mortgages. So, and I love working with Fairway. I can tell you, this is the best company I've been at, and I've been at a couple. And we close on time, we do what we're supposed to do, and I have a good staff behind me to make sure everything rolls out, especially our reverse mortgage staff. They're amazing. So that's what we do, or that's what I do, and I'll take it over to Judy.
Thanks. I'm Judy Lewis, branch manager of Guaranteed Rate Mortgage, and I've been doing this 39 years, just had my 39th anniversary. Guaranteed Rate is actually the best company I have worked for since the mid-90s, so I've been very fortunate. We have every product under the sun, both in-house. We're direct, obviously. We're a national lender, huge national lender, but then we also do have tons of investors to do the outside the agency boxes, you know, the bank statement loans for nationals, condo tails, all that kind of stuff that Fannie and Freddie and FHA and VA won't do. And I specialize in anything from first-time home buyers. I mean, I'm a condo expert, condo financing expert, and we are the #1 non-bank jumbo lender in the nation. So we have excellent relationships with the jumbo investors.
All right. Anybody have a question to get us started? Yeah.
I know there's a lot of products out there with different names, but can you guys address the product that makes it look like that the customers are closing with cash?
DSCR.
Cash to keys.
That too. Yeah, I knew it had a bunch of different names, but yeah, can you guys help me understand that?
Well, there's a few different ones. Like there's the ribbon, and probably what you're talking about, cash to fees, which will, like for a 1% cost, an investor will buy that house cash and then allow us to finance it for that client back. And then there's DSCR, which allows them to have no income. So I would say those two.
Annie Mac has another one that's called Buy Now, Pay Later, where essentially if, say a person they need the proceeds from the sale of their current home in order to buy the new home, maybe for a job, relocation or something like that. There's an investor that will buy the new home cash while they wait for their existing home to sell. They can actually lease back and move into the new home if they need to, while they wait. And there's about a year that can go, that gives them that time to sell that prior home.
Anything further?
Well, we have the DSCR as well. We have those programs, and that's a pretty cool program. And they're doing, if they're going to buy an investment property or something, for example, and they're not going to, we just count the investment payment, the proposed payment on the investment property. It's not anything like a Fannie Freddie conventional. It's completely different how they qualify. But, you're not going to get a Fannie Mae Freddie Mac fixed rate mortgage on that either, with the rates. The rates are going to be different for sure. The ribbon, the thing where there's companies out there that will, I was wondering if this is what you were referring to, which is where they give the borrowers have a house to sell, but they can't sell it for whatever reason in time, and they need that equity. And Ribbon, I believe, will front that equity to them, and they go ahead or they buy the house, and then about 6 months, 9 months later, whenever the people sell their house, they pay that off with Ribbon. And then, is that how it works with Ribbon?
Not Ribbon.
No.
We
Not
have Cross
Ribbon.
Country has a partnership with Ribbon, and it's essentially what they do is they'll buy the house cash,
Right.
and then for a 1% fee, the buyer pays 1%, and then we finance it.
Then maybe it's not Ribbon I'm thinking of then, but there's a company out there that will front the money, front the money for the house. Well, I guess it's the same thing as what you're saying, but
I think that's.
but
what
I
Faith-
thought the
what
house
you have.
house was put into their name.
Yeah, so
I think that's what Faith was kind of talking about
It is.
at Animac that they have.
Yeah.
Maybe.
That was gonna be my question. The investor is buying the house and it's in the investor's name?
So the Ribbon company buys it for the client at 1%, and then we have a partnership with Cross Country. So then we basically refinance that loan for the client, or they buy it right from them, as long as they can go conventional, because it wouldn't work FHA with flip rules.
So temporarily, the house is in the company's name?
In this Ribbon company's name, correct?
Okay.
They're all very similar, and they serve the purpose. And the
It's just
fee is
really for
pretty
that
much
competitive.
just- It is to be competitive and to be able to serve the customers.
Eva has a follow-up?
Yeah, how long does that process take? The reason we need this is because of the market.
They can close same as
We
cash.
need cash.
So they'll do same
do
as
they come
cash.
to you first and get qualified?
Correct.
And then they can act like a cash
Correct.
customer?
That's
once
exactly
you-
right.
With AnyMac, we actually want them to truly go through the upfront underwriting process.
Us as well.
I'm not doing just a pre-qualification on these folks that want this kind of
But what if they
transaction.
don't have a property picked out yet?
They don't have to.
They don't have
Okay.
to. It's truly the upfront underwriting part first. They don't have to have a property just yet, but they do have a loan commitment in place.
Correct.
And then AnyMac has its own investor affiliate business that handles this. So we are not partnered with Ribbon, or we can do Ribbon. We're approved by them, but it's all in-house with AnyMac for the most part. I will address something I've heard recently from some realtors. Just a knee-jerk reaction has said, well, that's illegal. And it's not. It is a completely separate entity that actually buys the home. It is not illegal. So I kind of want to put that out there just to diffuse any kind of chatter that I have heard, because that's not cool. And not fair, because the effort is truly to help all of our mutual customers be able to buy a home.
And Fairway has a kind of different twist on this. We have a guaranteed loan program. Just like Faith said, we pre-approve the client up front. Then they will receive a guaranteed letter from us stating that they are fully qualified. So when you take it to your seller agent, then it's more likely that they're going to accept your offer because they have been fully underwritten. If for some reason during the time of application to the time of closing, if something happens, they lose their job, they go out and buy a car that they were told not to buy, but they did it anyway, then Fairway gives them a couple options. They will buy the home from the seller, so the seller does not lose anything for the appraised value or the purchase price, whichever is less. Yes.
How long does that process take? Because usually we allow 30 to 45 days for a mortgage. When you do something like this, how quickly can you close?
We're pre-improving them up front, so we're looking at 36 to 48 hours max
To close?
to,
Okay.
yeah, for full approval. And then we don't want them to sign a contract. We want them to wait to sign a contract and get fully approved, because once they have a contract, it doesn't really matter. This guarantee is for the seller to be more comfortable accepting your offer.
So there's no property.
There's
At
no
that
property
point,
yet,
so-
and we do not charge the buyer. There are programs out there that do charge the buyer points for doing this, but we do not charge the buyer. Everything is done through
Once they
Fairway.
have a property, how quickly can they close?
Well, we've already gotten everything up front, so as soon as the appraisal's done and the title, we're ready to go.
Okay.
Yeah. So it depends on basically the appraisal. You know.
Okay, so going back to when you were saying that the home was actually going to be owned by somebody else. If I was a listing agent and I was accepting a cash offer, I would be asking for proof of funds.
Correct.
But is that in the buyer's name or is that in the company's name?
It's in the company's name.
Company's name.
Okay.
So you're writing the contract as if the company
Correct.
is going to be the owner, not
Correct.
the individual.
Correct.
Right, so if
And
the
then it
company.
gets refied into the customers.
Right,
Correct.
once the seller sells to the company, the seller, there's no risk to the seller.
It's just like selling to any investor.
Yeah, it's just
basically.
like any investor paying cash.
Yep.
So AnyMac has, for the programs, plural programs that we offer, we have an education process. Takes about 20 to 30 minutes max. And it's online, and it is a thorough education about how these different programs work and function, and will help with being able to complete the contract correctly so that everything runs smoothly. And if you're interested in that, I'm glad to give you the site and set you up with it.
Anyone else? Okay, so I'm gonna ask a question for the new realtors out there. Tell us about TRID. What is it? What does it mean? Why do we care? Let's see, Deborah, you want to start?
We don't care, but we have to.
We're forced to care.
We're forced to. Yeah. So that's our wonderful federal government who decided to bring out TRID to protect the buyers in the process. So basically, it gives us wait times for everything. So we have 3 days after the application is taken to send out our loan estimate, and then when we're ready to close, we have 3 days to send out our closing disclosure, so that buyer has 3 days to actually review the numbers and make sure that what their loan officer has told them is correct, the rate's correct, everything's correct. And it's a way to monitor us. They did change, obviously, we're no longer using a HUD, we're using a closing disclosure, so they did change the verbiage. But basically, that's what it is. It's just the federal government monitoring us to make sure that our customers and your customers know what they're signing by the time they get to the closing table.
I think the spirit behind it was so that there's no surprises to the consumer. There's some additional guidelines that are associated with that in terms of percentages of change in numbers. If you think prior to TRID, oftentimes our customers they were surprised at maybe an increase in a cost that even the lender has no authority over. And so that just wasn't consumer friendly or kind. And so I think the spirit behind TRID was really to eliminate those surprises so that the consumer truly knows how much money, or at least a ballpark of how much money they need to have for their transaction.
With TRID, which is basically the truth in lending and the good faith estimate, were two separate
Merged.
documents. And then the HUD one was the closing document. And you did a final truth in lending with that. So they integrated it. That's what TRID is, the truth in lending RESPA integrated disclosure, something like that. So they've integrated it. So the loan estimate is the truth in lending and good faith combined, and then the closing disclosure is the final truth in lending and HUD combined. The lender fees cannot change. That's one thing, that whatever we disclose as our fees, that cannot change. There are some tolerances, prepaid taxes and insurance, those can change. Title fees really can't change. So we disclose title fees based on a hypothetical to whatever title company. And as long as whatever we disclosed is equal or higher than what the actual title fees are, then we're within compliance with that. There's a little bit of room, maybe 10%. On some of these fees that are out there, and then there's some fees there's no tolerance whatsoever. Like I said, the lender fees, there's no tolerance. So we can never change our fees unless it's something where something came in, a rate lock extension. Let's say that they had to extend their rate lock for some reason and there's a cost to that. We would be able to charge that extension fee and have to redisclose change of circumstance in the situation. An appraisal came in low, the loan to value changed, now there's mortgage insurance. So certain fees change. So then we would have to do a change of circumstance. We would be in compliance to redisclose because something changed. There's only certain things that can change. It can't just be anything. But, you know, so that's what Faith was saying as well, is it's there to protect the consumer. It is a little more confusing than reading the loan estimate than the good faith used to be. But our job as loan officers is to go through that loan estimate with them to make sure they fully understand what that is. And you know, we're not allowed to show a seller credit on the loan estimate. So if the seller wants to give a $5,000 towards buyer's closing costs, that's not going to be on that loan estimate, but it'll be on their 1003. On their application. Things like that that we would want to walk them through so that they understand, you know, what it means.
We don't love TRID. I'm just going to be brutally honest about it. We do not love it.
We're calling it the reason I drink.
It has been an ongoing mind-boggling experience because while the effort and the spirit is sincere and genuine, the actual process is hellacious. And
I think we've all got it down by now.
But there it is. Like the change of circumstance happens, that can be confusing for the consumer. So it really requires patience on everybody's part to just kind of give yourself over to the process and try to understand. Nobody's trying to take advantage of anybody. Our companies get audited. You know, there's no way to hide this. So, anyway, we don't love TRID.
One thing I just wanted to add. That disclosure, the preliminary closing disclosure that must be sent out and signed by the borrowers at least 3 business days prior to closing, and Saturday counts in that, but bank holidays don't. That 90% of the time, I would say, that disclosure that goes out for them to be able to lock in that closing date, that's usually a preliminary closing disclosure. That's not their final CD with their final figures. Right. Usually the title company hasn't even gotten that yet to even tweak their end of it. And so that's another thing that gets a little confusing for our customers, is they say, wait a minute, I don't see this, or I pay, and it's like, we have to explain, this particular disclosure that you're getting today is for you to acknowledge that we have provided you at least a preliminary closing disclosure so that we can guarantee you can lock through at least this date that you have it scheduled. But the final disclosure with the final fees, you know, could be the day before closing, but by the time the closing department and the title company have tweaked their sides and have matched.
I often use the phrase order of operations. And in our industry, a lot of things are domino effect. So one tick has to happen for the next tick to happen, for the next tick to happen, and there's that order of operations. So that acknowledgement of that initial closing disclosure or preliminary closing disclosure is significant, because that's actually time.
It allows the next step to start.
It does. It allows the next.
Otherwise, we just sit here.
That's exactly right. We sit and we wait
until
for an autograph, literally, for something that's not final. But it's that serious. So, yeah, is what it is.
So I would say everyone on this panel calls the customer and lets them know that the closing disclosure is out, that it is preliminary, explain what that means, and then let them know they need to sign it before midnight if they're going to close on time.
That's exactly right.
The key is you're going to close on time if you sign this. And then we do explain the difference between the preliminary one and what the final one's going to end up looking like. So.
The ideal situation is for us to tell them up front that, you know, the process, what you expect through the process of this loan application, and that if you tell them up front a few weeks before, you know, you are going to be getting a preliminary CD. This will not be your final CD. So, and that way, when you call them the day they're getting it, they're they were already prepared to understand that that also helps.
Expectations are huge.
Yeah.
Setting expectations.
And we let if you're the listing agent of the selling agent, we let you know as well that, hey, the CD's gone out. You might want to just touch base with your borrower as well, because we're doing it too, but just so you know that it's out and it needs to be signed, in case they have any questions for you as well.
Oftentimes, if the borrower misses that signature, and it can cause delayed closing.
Of course.
And I've had listing agents just angry about it, but that's why there's that provision in the contract that allows for the additional time, and it makes specific reference to TRID, or the Consumer Finance Protection Bureau. That's what all that means. It's not that we've done anything wrong. It's that somebody didn't sign timely, and so it's serious. We don't love it, but it is serious.
There are customers that sometimes don't return our calls and emails in a timely manner.
There are.
And no matter how much you try and bake them,
Exactly right.
Pretty
you
sure
know,
we all
and-
deal with the exact same
We do all
clients.
three. We text, we
it
call.
happens.
Exactly right.
And you're like, you're texting them, you're like, please, and
Work with me here.
oh
I'm
my
trying to
gosh,
help
so
you.
that happens.
Like, this client hates me today because we just asked for their bank statement and they had to provide it at the last minute.
You've seen that meme where it says bank statements, all pages.
And they keep sending their screenshots.
Yeah, mobile
Like, we
screenshot
can't use
doesn't
it.
even have their name on it.
Anyway,
We all
have the same.
We all
Oh,
suffer
yeah.
the same.
The
problem.
link to the bank statement line online, which of course can't get in.
So speaking of bank statements, talk to us about bank statement loans. I'm hearing this term a lot.
So bank statement loans are a great way for self-employed borrowers to still get financing. They've been around forever, just not really super attractive over
Famous
the last
until
few
now.
years.
Yeah.
But now that rates are going up, the bank statement loans probably priced just like the others, and
Yeah.
we can 10% down. I mean, probably even with 5% down,
I
they're
have
out
one
there,
that's
but
5,
the
yeah.
rates are not going to be very good. And usually they're going to use 50% of the deposits that come in, or if it's a 1099 type of a borrower, like a hairdresser or someone of that nature that gets paid 1099 and not necessarily owns a business. Those people we can, with a CPA letter can usually do 65% of the deposits.
That's right.
I would say that's pretty traditional.
That's pretty standard, yes.
It gets you the house.
Yeah.
Especially depending if you're self-employed and you're taking every deduction under the sun where you really don't have any qualifying income. It gets you the house. The key is deposits.
Yep.
And depending on how long been in business, might need 12 months of bank statements, might need 24 months of bank statements, but they must come from the same account. So customers got to really know where they're depositing their money. And it can be a personal bank statement or a business bank statement. But so whichever account is going to have the most deposits is what's going to be most beneficial for them to qualify.
They're honestly pretty easy loans.
It's a great product.
It's a great product.
Credit score is
aside from
important,
just
though.
collecting the documents, it's a really easy loan.
If
You're
you
right
want
about that.
10%, you want
Credit-
10% down, you're going to have a decent. You're going to have a 700 credit score or higher, 720 maybe, on a lot of those investors with only 10% down.
Yeah,
I mean, you're not going to get a 620 and put 10%, 620 credit score and get 10% down on a bank statement loan.
That's true. The smaller the credit score, the larger the down
down
payment's going to need to be. And people say, why? They obviously, if their credit's challenged, they probably don't have much
Well, that's
money.
why that's
what is their worthiness? They
haven't earned it
and
yet.
they haven't earned that
right.
that benefit yet. And
Also, the shoot just flipped right out of my head. Something you were saying. It'll come to me. It was about the bank statements, but just went right out
You
of my
want to
head.
have a follow-up on that?
a lot of that has to do with risk as well,
Yeah.
from the lending perspective, that the smaller and the more challenged the credit score or credit history, then the larger the down payment, that kind of mitigates some risk that's on behalf of the lender.
I remember what I was going to
Okay.
say. I turned 60 and being self-employed in the same business, owning that same company for at least 2 years is also usually very critical. So if they owned a hair salon and they were self-employed, and then they switched over and now they're a realtor and they're
That's-
1099 for you, that's not
Yeah,
going
that
to
doesn't
work.
That's not gonna work.
Not gonna
Yeah.
work.
So I just wanted to let you know, yeah, you need to have the same company
Same
for at least
business.
2 years.
Or industry, yeah.
And there's some,
something.
cross country has some, like our bank statement is in-house, but we also have a 1099 only program and some really creative things for those self-employed, even with 1 year. So, I mean, they're coming around. The non-QM products are coming back like they were from before. They're just a lot more restrictions on them now than what they were before.
Oh, yeah.
Like used to, we could use first page only bank statement loans. Those were nice.
Yeah.
Those days are over.
NSFs are a really bad thing on a bank statement
Oh,
loan.
yeah.
Also,
Oh, yeah.
a decline
Great
in
point.
income is going to be analyzed
FHA.
really significantly.
Critical.
So if like they're declining more than 10% over those deposits, it's going to be a hard loan. They're a lot more picky on that stuff because they're looking at the actual cash flow.
Also, transfers from another account into the
Those come
account
out.
that you want to use
Those are
is
not
not considered a deposit. It may show deposits on their bank statements, but if they transferred that money from somewhere else into their business checking, for example, that's not going to be counted as income.
Right. Or like SBA loans. There's all kinds of like
Yeah.
weird things people think are income that really.
They're looking at
is not.
actual income from generated by the business
By
for
the
the
business,
deposits.
All right, so, again, new realtor hat, putting that on. So there are 4 loan programs that you hear most often. You hear FHA, you hear VA, you hear conventional, and now you're starting to hear more and more USDA. Who wants to talk to us about USDA?
Well,
Any one of us.
Deborah?
Okay, so USDA is a rural program. It used to be, if you're old as I am and you've been around a long time, it used to be Farmer's Home, but it's now USDA, and it's based on rural areas. So USDA has a map, and you put the address in on their website, and it'll tell you whether or not it's eligible for USDA loan. They can go 100% financing on a USDA loan, which benefits a lot of first-time home buyers that may not have the cash to put down, but they have the cash to do closing costs. So it's a really great program, depending on, if you're okay with living pretty much out of the city limits versus in the city limits. So,
Like for a while there, until about 4 or 5 years ago,
Yeah.
even south of 442 in Edgewater,
Yeah,
Indian River, that part of Florida Shores was eligible. North of 442 wasn't. Of course, they redid the maps several years back, and really now it's more down to Oak Hill or maybe way out in Samsula or Bunnell. So as she said, it's rural. But if someone wants out there in the rural areas, it's a great program.
I like
There is
to
also
say-
there's also a fee, like 2 point something that they charge, and like VA
Like
has a
FHA.
funding fee, or FHA has an NYP up front. Well, USDA has that, and that can also be financed into the loan amount. So their loan amount could actually be slightly higher than the sales price with that.
It's
So
all,
I was
I'm
gonna
sorry,
say,
go
like,
ahead.
it's a super picky loan though. Like I call it a purple unicorn. I usually close 1 a year. If I close 1 a year, it's a really hard product for the client to qualify for. They have to have depth and credit. Their credit has to be like perfect, like better than conventional. It's income, driven, so they can only make so much money. So it is not an easy loan. It's not like your average first-time home buyer is not going to qualify for it.
And she's right, it's income driven and it's household income driven. So say family has grandma that lives with them, and husband and wife are on the mortgage. But grandma, she collects Social Security. She's older and she gets Social Security. Her income is part of the household qualification,
Correct.
even though she is not to be on the mortgage. And there are income.
And if there's teenagers.
Correct. And if they have a job at Publix,
You
their
gotta count that
income
too,
is
so it pushes them
calculated
over.
into household income. And remember, they're getting a W-2 from Publix because they've worked. So,
They can
and
check
this
it.
is a government loan. So can't hide that stuff.
There are income limits.
So there
on
are income
on
maximums.
USDA,
It's like
there's
80-ish.
income limits.
Yeah, and it depends on how many members are in the household.
It does.
There's charts
And
that
the
we have
county
to
and where
look
you're
at,
looking and all that good
as
stuff.
well as location and median household income, that kind of thing. So there's a lot of variables in that transaction. But interestingly
Super picky
enough,
quality, and the house is,
she's right, but I do more than one a year. They're kind of ideal for that first-time home buyer who is willing to cooperate with those guidelines. And we can use down payment assistance funds through Florida Housing with them as well. So for that first-time home buyer, it can be beneficial. It does require patience.
And the debt ratio is
tight.
much
Has to be,
lower
yeah,
than
lower.
It's still
That's
hard.
correct.
much lower than FHA, VA, and conventional, even
Yeah.
conventional. Yeah.
All right, so we've dealt with USDA. What about the horror that we're all hearing about with VA appraisals?
Oh my
Anybody
goodness.
want to talk about that?
Yes, I do. I will.
Okay.
One of your colleagues, Kevin Boudreaux.
He's not my colleague. I don't know him.
Oh, well, he's with Fairway Independent. I figure he's a colleague in your company. But he came up, he actually did the research, so I want to give him credit. So I didn't do the research, he did. The percentage of appraisals on conventional financing that have come in lower than sales price, is actually higher than the percentage of VA appraisals that have come in low on VA transactions. There has been, yes, and there have been a lot of just this spread through the realtor community that, VA appraisals are hard to pass, FHA appraisals are hard to pass. Well, if the house is maintained properly, you're not really going to have an issue with the VA appraisal. Yes, VA appraisers and FHA appraisers have to do a little bit more than a conventional appraiser would have to do. Many times they're the same, Rich Allen does all three, but does
well,
two,
he can't do VA, unfortunately.
not the VA, but he does, but my point is, that they, it's the same, appraisers, but they know on FHA, they got a little bit more. The VA appraisers, I just had one, Neil Buckley, he does conventional FHA and VA. He knows on those, he has to do a little bit more, what the agency requires them to do. But I heard a realtor at the District 2 meeting literally say that VA appraisers are trying to kill the deals. And then she said, I've actually heard 2 VA appraisers say that that's their job, to kill the deals. That didn't go over real well with the attorney that was there from FAR, because I talked to her privately off to the side of the room. And she said, you got to remember, a lot of our veterans are disabled.
That's right.
And they are a protected class. And I have been fighting. I've been putting it all over Facebook. I brought it up at the District 2 meeting at the luncheon. Be careful about saying, you'll only take cash and conventional loans. And I put something, somebody just did a meme, and I shared it the other day on my wall. Before you reject my VA offer, remember my down payment, and it's them, in battle. So I'm really fighting strong about this, and because I'm beyond upset that this is happening to our veterans. So
Yeah, I hate to get somebody call me up and tell me that their offer wasn't accepted because they're a veteran. It's like, it should be the opposite
That
way.
is so
It
wrong.
should be the opposite, every day, all day long, I don't care.
That should have been the priority.
what I said at the District 2 meeting, and what I've been saying to leaders in the community, is their offer should at least be considered. The seller doesn't have to take it, I'm not saying that, but they should at least have the right to put an offer in, and if the seller doesn't want it, fine. But to not even let them put an offer in, I think I think it's immoral and unethical. It's not against the law,
Should be.
but it's not right.
Yeah, it should be.
It should
Yeah.
be.
Thank you for addressing that. Anybody else? Have another one?
I'd like to understand reverse mortgages a little better. I actually have a client that we're trying to get a property sorted out, and it's really confusing.
Is it a reverse now?
Is it a purchase?
It's the seller, it's a really confusing. The seller's mother took it out after the seller's husband or father died, and she didn't have any means to support herself because he had always taken care of her and he was self-employed. And so now the son and daughter-in-law are living in the house, the mother has passed, and so we're trying to sort everything out so that we can
How long ago did the mom pass away?
3 years.
Oh.
And
Oh, yeah.
And they still have a loan on
And they
that
still
house?
have a
How is
loan
that
on
possible?
They haven't taken any additional monies out, they're still owing the interest. Yeah, it's.
So do they not know she passed away? Because like they only have 6 months.
They
Yeah,
only
that would've been
max a
foreclosed.
year. You know, they're not gonna let
I
them sit
went
for
to the
3
title
years.
company, and the title company has done a lot of research and a lot of connections and put me in contact with some folks.
Do they want to keep the house or are they trying to sell
Yeah,
it?
we're trying to sell it. But yeah, when I spoke to them, that's what I said, and they said, well, no, because they're not taking out additional monies.
But they only have like, no.
That's
No,
what I
that's
thought.
wrong.
Once
said,
they die, they
you
have
know,
6
6
months and then
months.
they'll give them an extension for another 6 months.
And
But
that's it.
Yep.
And then
Another
it's over.
3 years.
And they foreclose.
Wow.
It's crazy. So I just feel like there's something that I'm missing, I just don't understand.
There's definitely
what to
something
do.
missing.
And
They didn't tell
So
they didn't
to
tell the
address the
lender.
process of a reverse mortgage. Deborah, you brought it up at the beginning. Why don't you start? and then
Okay,
we'll-
so basically a reverse mortgage is just like a forward mortgage, only it goes, how I explain, only goes in reverse. So basically, if you're 62 and older, you can purchase a home using a reverse mortgage, and you can refinance your home using a reverse mortgage. You can do both. So if you're, say you're 62, you want to buy a house, typically you're going to be putting 70% down. But that's cash people that are going to buy for cash anyway. They can go ahead and put that 70% down, and then as their equity grows, and their balance is going to grow, because remember, we're reversing. We're not making a payment, no principal and interest payment. They're paying taxes, insurance, HOA. So their balance is increasing every month, and hopefully their equity is increasing every month as well. So the beauty of it is that they will have a credit line and the open credit line plus for 150 years. Now, I don't know about anybody else, but I'm not living to 150. Don't plan on it.
Don't want to.
I would probably be shriveled up by then. But anyway, so that's basically how it works. I mean, you don't make a mortgage payment. Most individuals have a problem, with the closing costs, because since they're not paying a principal and interest payment, we do have to collect the mortgage insurance up front, just like a regular FHA loan, because it is an FHA product. And then they're charged 0.50 every month on a monthly basis, and that's added to the balance as well. So the balance, their balance increases. On the forward mortgage, their balance will decrease. Typically, is after 5 years or so is when you'll see the most decrease starting on a forward mortgage. But as long as they're 62 and older, they qualify. But the caveat is they are looking at credit now. So if there's issue with credit, I have an individual that had some 30 days, some 60 days and so forth recently on credit cards. They will require them to do what is called a LISA, and then we hold back so much money to pay their taxes and insurance to make sure that they don't default on those. And that could be a big chunk. Depending on the appraised value, the loan amount, etc. In my case, it was like 41 grand that they're going to hold back. So not everybody that's 62 and older should look at a reverse mortgage. Doesn't necessarily mean that it's going to fit in their financial planning, but if they have a financial planner, the best thing to do is to sit down with us and the financial planner, work out a plan and make sure that it's the best fit for that customer.
Two things I just want to add to that. The older you are, the lower the loan to value they're typically going to lend to you.
That's right.
So if you're 90, you're not going to get the same loan to value if you're 62. And then the other thing is reverse mortgages had a bad rep, had a bad feeling to them for a long time, because years ago the fees were outrageous. They were charging 8-10 points. It was something crazy a long time ago. That's not today's reverse mortgage. It hasn't been that way for a long time.
Yeah.
So
Tom Selleck
Also-
is the
No,
spokesperson.
so FHA has made a bunch of changes because of the negativity for the reverse mortgage side, and one of the major changes is, like, if you're 62, your spouse is 59, 55, 54, 53, whatever the case may be. 62-year-old passes away. The wife can still stay in that property for the same amount of time. She does not have to leave. She doesn't have to make a payment. She doesn't have to do anything but pay taxes, insurance, and HOA.
And maintain the house.
And maintain the house, yeah. So that was one of the major changes they made to make sure
And
that.
Another
didn't
one
happen.
is that the foreclosure. A lot of the people were like going upside down, and then the bank would take the house back in the 80s, and that's not happening now because of the PMI. Or the beneficiary would be left with whatever that balance was, which was also a huge thing that I've heard from lots of clients. But the PMI insurance now covers that, so there's no if they do go upside down after the person dies, then that FHA PMI covers that negative, so that whoever the beneficiary is not stuck with that negative.
Also, title insurance
The title insurance, of
participates
course, is
in that
going to.
as well. So there's protection.
So there's a
there.
lot of protection now for them. So it really allows them to buy, like if someone has is going to buy a $300,000 house cash, now they can buy basically a $500,000 to $600,000 house and have no payment.
Yeah,
So it's a
depending on the
pretty
rate.
awesome way for these clients to take advantage of the equity that they've built over their time. It's just really a misunderstood product.
Yeah.
So in the case that Mary Ann mentioned, what should have happened?
They should have given them 6 months to refi or sell the house, and they would give them another 6 months, and then after that, they're going to foreclose on it.
I'm curious how old that reverse mortgage is as well. How long did that woman have it before she
She's been
passed?
on it for 3 years, and I think her husband passed away maybe 5 years
Is there
before.
probate going on, maybe?
That's what, is there a
Sorry?
Is there probate?
Is it hung up in probate? That's all done? And was
Oh.
the mom on title, the one that passed, was she on title? And her probate's
I don't know,
done?
because now it's titled in a trust with their son and their grandson.
Maybe it's
So
something
now
to do with that trust.
I was
but-
gonna say.
Yeah, if the
Still.
trust has got a hair in it somewhere, that
Yep.
could mess it up. I would venture
And they're
to
just
say
getting
there's
lucky,
a
really, at
title
this point.
insurance claim pending on that
There's,
as
there's
well.
obviously something that we don't know because, I mean, if they're doing it, they've been able to keep it, so.
Yes, ma'am.
Yeah, they, sorry, no, go ahead.
So just to clarify, what the process when somebody dies on a reverse mortgage and there's beneficiaries? Would you say that again?
So they're going to designate those at the beginning. So they'll either designate one person, or they can designate all their kids, or whoever it might be, or they could designate their trust as that beneficiary. So at that point, that beneficiary will be contacted, then they can refinance or they can sell. And they'll have 6 months typically, and
they
then
would refinance, they'd have options to refinance.
on their own, just
On their
however they want
Because
to.
they're gonna be younger.
Correct,
Okay, gotcha.
correct. So they refinance it into a forward, traditional kind of a mortgage.
And then that refinance pays off the reverse mortgage
Correct.
that has a balance
If
on
they
it.
want to keep the home.
So,
right.
so if there's equity, more than likely the heirs are going to want to sell the property.
Correct.
And take the equity, just like you would on a normal mortgage. You know, you sell the house, you take the equity, same
It'd just
would
be
be
like
on
if
the
they had a
reverse.
mortgage
But-
balance.
But
just
if
like
they're,
anything else.
if they get a deficiency, like we used to do short sales, well, the FHA covers that, then they
Correct.
only have to pay the appraised value.
So you addressed if the person dies, but according to the commercials and Tom Selleck, when you leave your home. So I have some clients that were wanting to purchase what they know is a reverse mortgage upstairs from them because the woman's husband died. It's now in her name only, and she has gone to assisted living. So she has left the home.
She's not allowed to leave the
She's
home.
not allowed to leave the home.
So what then is the process? How
Technically-
does the mortgage company know she's left her home?
Someone would have to report them. I mean, they would have to be checking up on it.
They send out a letter every year,
Yeah.
and they have to verify and sign that they're still living in the property, so they will
So if
find
they've
out.
got a family member doing that, I mean, that could,
Yeah.
I mean,
We call that fraud.
it is.
And it is,
fraud. I mean,
and it's fraud against the federal.
It's an occupancy fraud.
I'm not gonna say it doesn't happen, though. We all know these
I mean,
clients
we
out
know
there, and
it's
they're gonna
out
figure
there.
out a
Don't
way,
forget that
you know.
mortgage transactions are of any kind are federally regulated.
That's
So
right.
any fraud on a mortgage of any kind is a federal offense.
Yes,
Yes.
it is.
And can be, it's a big deal. It's not a small deal.
So maybe he should contact whoever might be taking care of that property and.
Yeah, and I don't know that, but he would probably know. There's also no way to figure out how much money has been taken on the mortgage, correct? So there's no way to know it without going to the
Correct.
person whose name the mortgage is
Through that
in.
mortgage company. Yep. You could find that
How much is
online
that?
because you could find the recorded mortgage.
I'm sorry?
You could find
You
the
can find
recorded
the recorded
mortgage.
mortgage, and if it's been assigned somewhere in there, you'll find the
It's just been
assignment.
assigned several times.
You
So
can
you
track
can find
that.
it. I mean,
That's
it's
that's
public
what a
record,
title
so.
search does. That's an abstract, and you can figure
Anyway.
out who that is.
Where there's a will, there's a way, but
That's right.
they can't leave the house.
Anybody else?
Well, they can go shopping.
Right, but they can't like move out. They can't move out.
They can't do that.
Yeah. They
Specifically,
can't
they
move out.
cannot move out to assisted living and they keep the reverse.
It doesn't protect them at all, or no, it's
No,
just.
that's the rule of
That's
the
the
reverse
rule.
mortgage. They sign that they have to remain in the property.
It's just like any
It's only
other
fair.
FHA loan, you're supposed to be your primary residence.
Right. Correct.
Yeah. And FHA does check. I mean, I had a customer on a forward mortgage who was working out of state. His girlfriend, fiance or whatever you want to call it, was living in the house. They did buy the house as a primary residence, but he never changed his driver's license. And FHA picked up on that, and they went after him big time and made him refinance that property into an investment property. Even though it was his primary residence, he claimed that he had no way of changing his driver's license. They didn't care. Yeah.
There's other
To them,
states that
was
are
fraud.
auditing now people
Yeah.
who moved to Florida and call this their primary because of our tax benefits.
Yeah.
So these other states are now auditing those people
you
if they
gotta be
haven't
very
changed their
careful.
registration or if they haven't, because if, like I talk to clients about this all the time that are wanting to have a primary in Florida and a primary in Michigan, right?
Right.
And it's like, okay, well, if you're going to buy it as a primary, you need to first of all change your driver's license and your car registration, which means now you get to vote here.
That's right.
Are you okay with that? You know, and you've got to kind of put it in that perspective for them. Like, this is the number one source of loan fraud. I promise you, FHA and Fannie are both going to check this. And I can promise you, your state in Michigan is going to check too.
Oh, yeah, it's with IRS and
They're using
everything.
voter
state.
registration now to-
Yep.
to-
So it's a
they're
big
using
deal. So
voter
I've been telling these
registration
clients, if you want to call this your primary, that you need to understand that means you have to now vote here.
That's right.
Only here.
And then they're like, oh, that doesn't work. And I'm like, exactly.
And
So this is not your primary.
And they can't split that up where husband comes
Uh-uh.
and does all that in
No.
Florida and then wife doesn't, but yet
The
they
IRS
both
doesn't
want
like
to
that.
be on title. That's not cool. And that's
The
not
IRS
going
is
to work.
not gonna, they definitely look at that. So.
And that's why people think we're mean sometimes, because we tell them straight up
No, we've
that
just done
that's
this a
how
long
it
time
is.
and we all have been there.
You know,
Yeah, but all we're trying to do
sorry.
is protect them. We don't want we don't want them to get in trouble.
And
by
we
the
also don't
federal
want to lose our
government.
own licenses either.
Yeah, and we
Right.
don't want the FBI knocking at our door. I don't
No.
know. I don't like to wear.
I don't want to be a
their
witness.
uniforms.
I don't want to be a victim.
No,
I don't want to wear.
I've seen it. I have seen HUD investigate a loan officer back in Orlando, questioning things. I mean, the FBI. When I say the federal government comes down on this, I'm dead serious. I mean, we all are. These are federally regulated transactions. All but Fannie and Freddie are considered government. It doesn't matter. Fannie and Freddie are regulated by the federal government anyway. And there is a document in the loan disclosures that are sent out when they first sign, and
right.
it says mortgage loan is mortgage
is
fraud is
investigated by-
investigated by the FBI, and it has this whole
Got the
thing.
whole
They have to
badge
sign
on
in.
there
Yep.
too.
And one of
all
the
that.
biggest things that they look at is what we're talking about is occupancy status.
So number one source of
That
loan
they
fraud.
look at that. I mean, underwriters and the government is like, they do not want fraud on saying this is my primary and it's really not going to be their primary. It's my second home, and then they put a full-time tenant in it. It's an investment property. They are it's very scrutinized.
Well, Fannie and Freddie have figured that out, which is why second homes are basically gone.
Yeah.
Yeah.
I mean, there's really no second home product now. It's gone.
That's what I was gonna ask.
Well, the reason why they did the new the new director of the Federal Housing Finance Agency that was put in appointed last summer, she has come out on record saying that she wants Fannie and Freddie to be more like FHA, more for first-time home buyers and affordable housing, and she doesn't see. She's open about it. That's what she wants, and so they want to focus more on helping those kind of buyers get into their primary homes. They don't want Fannie and Freddie focusing on buyers that want to do a second home as a luxury item, investment property. You know, they don't want Fannie and Freddie. This is she's the director. This is what she has decided, and they pound on those points on second homes, made them as expensive as investment properties. Whereas prior to this, We had a little blurb there last year, but prior, for years and years and years, second homes for the most part were the same interest rate as primaries.
Exactly.
Yeah.
And now they've made it, but she wants Fannie and Freddie to be putting the majority of their money and their focus more like FHA and helping them first time in affordable housing.
So we have around 10 minutes left in our roundtable, and I don't know about you, but I found this to be very informative. Does anybody have anything else that they would like to ask? Yes, ma'am.
I think we need to go to condos.
Okay.
Some discussion on that perhaps.
Fannie has,
Fannie has
just made a huge change last July.
To
and
the
it-
questionnaire.
It's completely changed everything condo-wise.
Yes.
I do a condo class. I did one recently and had Judy Reichert join me. And I have a packet I'll give to you. I go
Great.
A to Z on a condo, whether it's qualified for Fannie or Freddie financing or if it has to be non-QM, and we talk about the why. I can't share all that for you in 10 minutes.
No.
It's just not possible, but I'm going to do another class here at the Board of Realtors. If you'd like to join, watch your email.
It's coming down to like for instance, we just closed one in, what was that one, Amanda? Sunrise. And the reason it closed, technically Sunrise should be a condotel, but most of the people who own it as a second home are not renting it.
Right.
And Fannie is not, they don't necessarily now, the question about minimum days is gone on there. They don't really care about that anymore. What they're looking at is how many people are renting it out, and they put it like on a little chart. And if it's more than what's it called? Where Jenny Snyder always is, I can never remember the names of them, but Seacoast. That one used to be warrantable and is no longer because literally everyone in there is renting those things out.
Yes. And it's a short term,
and they're
long
analyzing
term
it
they look
so
at as
completely
well.
differently now. It's like it's a whole new. They've completely changed the condos.
I also
100%.
I also have a presentation, and I've done that as well with condos. I did it at the Brandon Center. I've done it at Kai's. I've done it at a few other places too, and I have a thing. And I took it right off Fannie Mae's webpage when they changed it. It was actually kind of earlier last year, but what they're looking at is if the building is primarily transient, so
Correct.
if you 50% or more of those units are being put on as short-term rentals and renting those out, and what they look for, what underwriters are looking for, first of all, they go online typically and they Google the name of the
They Google the name
condominium
of the
building,
company.
and like for example, Moontide. I'll give you an example.
Moontide's out.
Moontide has
Out.
their own website. The association runs that website, and you have a calendar. You have the units picked out, and you can book a unit on Moontide's association website directly through the
Through Moontide.
association, like a hotel.
Yep.
Okay, so if the condominium has this website like that where you can book it directly, I'm not saying Great Oceans Condo is tricky.
Yes.
You'll Google the condominium's name, and it looks like, and it'll say, La Brisa's Condo Association, and you go, okay, here's the website. You click on it. It's really Great Ocean Condos.
Yes.
That's okay. Don't worry about that. That's just a property management company, But the key is, if the actual association or property management company is engaged in directly renting out and running a rental program like Moontide does, and has the place where you can book right online on their website, that's going to be a big if they have a rental desk on site like Moontide where they can go in and get their keys and they register and they get their all that stuff. You've noticed more and more condominium projects because of this change have pulled back. They've taken the rental desk off their site. They've even taken down this stuff on their websites and everything to rent directly is because of this. But yeah, what they're looking for is if it's more than 50% of the units are being advertised, and here's another key thing that they're looking for too. How is that building being marketed? If the listing is saying great investment property, tons of rental income, all that kind of stuff, I just be careful about that verbiage. You don't have to put that verbiage in. You're trying to entice people by putting that verbiage in, but it may, you don't want to present it as this is a business. You're going to be buying this as like an investment business.
So there's not really just one key that determines whether or not a complex qualifies, because it's the complex, not the unit, that qualifies. And one of the ways that Fannie has the guidelines set up, and Freddie has adopted it, so they're both the same, is that Fannie very specifically provides a list of criteria that disqualifies the property to serve and qualify as conventional financing. And so it's not hard really to look at that list of criteria that makes it ineligible, and if you communicate with the HOA, you'll know, well, they have short-term rentals right here, or it's transient, or they're, one owner owns more than a percentage, then that disqualifies it. And if that happens, then we look at the non-QM products.
That's what I have in my presentation as well as I copied it right. I took the page right off of Fannie Mae's website that specifically says what they're looking for, and then the automatic deal killers, and that's what's on there, and the transient thing, the rental desk, making it like they're running like a hotel service kind of thing, and Moontide is the perfect example of why they won't do it.
It's really just about talking to that client too, and making sure they understand that condos are different than single family homes. So if they're going to look at a condo, they just really need to be analyzing it, making sure they're asking the right questions, and understand we can do those loans. We can do condo. Every one of us probably can do a condo tel, but it's not going to be the same product as a conventional loan.
It's pretty minimum 30% down, right?
Yes.
I can do them 20%.
I can do them 20% as well, depending on their qualification.
Yeah.
And the other thing is, if we have to do them non-QM, you're looking at every bit of 60 days to close, not 30
Condo
days to
tels
close.
are definitely
Just
45 very best case, truly.
if we're lucky, yeah.
I'd like-
The interest rate on that would be.
It's going to be
Higher.
higher. It's not
Yeah.
pretty.
They're in the
But if they
7
want
points.
it,
You probably pay a point or two. I want to just
You can do
clarify.
interest only, you can do ARMs. I mean, so there's things out there to make them a little more attractive, but
I want to
it's a-
clarify that what the word conventional financing is, whether it's Fannie Freddie or it's a non-Fannie Freddie, like bank statement loans or a condo tel loan, that's still a conventional loan. Jumbo loans are conventional loan. What the difference is, conforming is to Fannie and Freddie. It conforms to their guidelines. Everything else is non-conforming. It's still a conventional loan. I just want to make sure you guys know that. So a condo tel loan, bank statement loan, foreign national, it's still a conventional loan. It's just non-conforming. And so it's the non-conforming, non-QM products that we would have to fit those kind of programs, those kind of condominium projects would have to go and that don't fit with the conform with Fannie and Freddie guidelines.
so a few things. Make sure you communicate with the HOA. And as far as your customer is concerned, a lot of times they're confused because they say, well, I qualify. I have great credit. I've got money for down
Do it with the
payment. That's great. That's just one element of the transaction. Remind them, and I do this every time, just remind them that the property has to qualify to serve as collateral. And if just basic observation of a condominium and the risk of a condominium compared to a single family home, there's no dirt. So with a single family home, there's dirt, there's title to the dirt. You put a fence up, there's dirt. Whereas a condominium, it's ceiling to floor and wall to wall. They don't even own the exterior. They own no dirt. So the risk is greater. It's like a floating room in the air. The risk is greater, and when there's great risk, it's going to be expensive and it's going to be analyzed very critically.
Scott, you had
Are you still seeing reluctance of associations to fill out the new questionnaire?
Oh yeah, they
Always.
are ugly, and some of them have increased they're just ugly.
The costs are ridiculous.
Cost is,
It's ridiculous.
oh my God.
Yeah, we have lots of fun with HOA.
Yeah.
So, in order to honor everybody's time, I want to say that if you as a realtor or a broker have these people as resources. You should invite them into your brokerages to do a condo class, or a class on reverse mortgages, or a class on investment properties, or whatever it is, and make sure that your agents have access to the expertise that's right there. We've seen a huge influx of new agents, and none of us want those new agents to fail. We want them to be successful. We love our profession. So lean on these folks. Use them to educate your newer agents or your more experienced ones who've never dealt with a reverse mortgage. I have not done that myself yet. So You know, I really, truly appreciate each of you for being here today. I appreciate each of you for giving your time to come and listen to this presentation. Spread the word. We are going to be doing a title roundtable. We're going to be doing a home inspection roundtable, and we're going to do an insurance roundtable. And then we'll probably come back and revisit our lenders again. So,
Might want to do appraisal.
I'm sorry.
Might want to do
Appraisals.
appraisals.
And,
That'd be a really good one.
We've got one in the area. I mean, we
there's a
Good luck getting them in. Good luck getting things started.
they're in Benicia.
They're busy.
One second.
They're-
The problem is they have to be affiliates with our board. So get them to be affiliates
okay.
and we'll have
Apparently we only have
appraisers. That would be awesome. So any final words from any of you?
Thank you.
Thank you.
Thank you for this
Thank you.
opportunity.
This
It's
has been
fun.
awesome. Thank you.